Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what big companies are up to, and today we've got a real treat for you. We're diving into the inner workings of a couple of investment funds, and trust me, some of the numbers here are going to raise your eyebrows more than a magician pulling a rabbit out of a hat. You know, if that rabbit was made of dollars and cents before we jump in. If you like getting these kinds of unfiltered looks at corporate finances, stick around and hit that subscribe button. And hey, if you want to chat more about this stuff and get insider tips, join our Discord community. You will find the link in the description below. So what we have here is a bunch of official reports from Tidal Trust, a company that manages investment funds. Think of them as the people who oversee the money for investors. The main stars of our show today are two specific funds, the FolioBeyond's Alternative Income, an interest rate hedge ETF, and the FolioBeyond's Enhanced Fixed Income Premium ETF. We are going to focus on their annual shareholders reports, which basically lay out how they did over the last year. The big date for these reports is the 31st of July 2025. That is the end of their financial year. This means everything we are about to talk about is from that period or leading up to it. Now let's get to the juicy stuff financials. They start by telling us about the costs for the FolioBeyond's Alternative Income and Interest Rate Hedge ETF, also known by its ticker symbol RISA. It cost about $109 on a hypothetical $10,000 investment over the past year. That's a little over 1%, which sounds like not much. But remember, these are costs on top of whatever the investments themselves do. This table here shows how different investments performed over time if you had started with $10,000. For the RISA ETF, that $10,000 grew to a whopping $18,163 by the 31st of July 2025. That looks like a pretty good return. Now, let us compare that to its benchmark, which is the Bloomberg US Aggregate Bond Index. That same $10,000 only grew to $9,644. Now, that's not a gain, that's a loss. So Rhode Island SR really outperformed its benchmark. They also compared it to another index, the ICE US Treasury 7 to 10 year bond 1x inverse index, and that $10,000 grew to $10,573. Still a loss compared to the start, but RISA did much better than both. Looking at annualized returns, Rhode Island's SR managed an impressive 12.50% for the year. Over all time, since its inception in September 2021, it's returned an average of 16.85% per year. That's a fantastic performance, especially when you see the broad bond market represented by the Bloomberg US Aggregate Bond Index. Only managed a tiny 3.38% for the year and actually lost money on average since its inception. So why did RISR do so well when the bond market struggled? The report says it's because the fund primarily holds mortgage-backed interest-only securities, or MBS-IOS. These things behave in a special way when interest rates go up. When rates rise, borrowers are less likely to pay off their mortgages early. This means the interest payments that the fund gets from these MBS-IOS last longer, and that increases their value. Basically, when rates went up this past year, these MBS-IOS went up in value, unlike most other bonds. This fund is not small, it's managing over $169 million. That's a lot of trust from its investors. What exactly are they invested in? Well, a massive 95.3% of their portfolio is in collateralized mortgage obligations, or CMOs. These are complex financial products backed by pools of mortgages. Looking at the specific holdings, they have a lot in Federal Home Loan Mortgage Corporation securities, often called Freddie Mac, for example. They own a lot of Series 389, Class C27 with a 4% interest rate maturing in 2052. They also have many other similar investments, spread out across different series and maturity dates. They also hold quite a bit in Government National Mortgage Association securities, or Ginnie Mae, which are backed by the US government. This shows they are focused on mortgage-related assets. This fund is much newer. It only started operations on the 22nd of January 2025. For fixed BAP, the costs were even lower, about $36 on a $10,000 investment. That's less than 0.5%. This is probably because it's so new and hasn't been around for a full year. Here, the performance looks a bit different, starting with $10,000. By the 31st of July 2025, it had grown to $10,099. So a small gain of about 1%. Again, compared to the Bloomberg US Aggregate Bond Index, which grew from $10,000 to $10,361. Fixed PEEF slightly underperformed its benchmark in this short period. Since its inception on the 22nd of January 2025, Fixed returned 0.99%. The Bloomberg Index returned 3.61%. So yes, it underperformed. The report explains this is because the fund has a shorter duration, meaning it is less sensitive to big interest rate changes, and it's designed to have similar overall risk to the index, but not always match its duration exactly. This fund is much smaller, with about $10.7 million in assets. What do they invest in? A huge chunk, almost 98%, is in other exchange-traded funds, or ETFs. This means this fund is essentially a fund of funds. Interestingly, a big part of its investment, 29.3%, is in RISA. The other fund we talked about, this is what they call an affiliated security. It also invests heavily in the Invesco Senior Loan ETF, the VanEck High Yield Muni ETF, and iShares Mortgage Real Estate ETF. They also have some exposure to purchased options and also written options, which is basically a way to manage risk or generate income, but it comes with its own set of risks. Now for the nitty-gritty, the detailed lists of what each fund owns. For RISA, as we saw, it is all about mortgage-backed securities. The values are listed in par and then the actual market value. You can see a long list of specific mortgage obligation series, maturity dates, and interest rates. For example, they own a lot of Federal Home Loan Mortgage Corp, Series 5410 Class IO, with a 4% interest rate. They also have significant holdings in Federal National Mortgage Association securities, another major player in the mortgage market. Remember, these are long-dated investments that benefit when interest rates rise. For FIXP, the schedule of investments shows its investments in other ETFs. For example, the FolioBeyond's Alternative Income and Interest Rate Hedge ETF is listed, along with the Invesco Senior Loan ETF and others we mentioned. For the written options, they've got contracts on iShares 20+ year Treasury Bond ETF and iShares 7 to 10 year Treasury Bond ETF. These are listed with negative values because they represent a liability. Looking at the balance sheet for RISA, its total assets are around $174 million, with liabilities of about $5 million, leaving net assets of just under $170 million. For FIXBEP, it's much smaller, with total assets around $10.8 million and liabilities of less than $58,000, leaving just under $10.8 million in net assets. The statements of operations tell us about income and expenses. For RISA, they had investment income of over $7.2 million, mostly from interest income, and net expenses of just over $1 million, leading to a net increase in net assets from operations of over $8.7 million. FIXP had investment income of about $373,000, mostly from dividends from other ETFs, and net expenses of about $40,000, with a net increase in net assets from operations of around $55,000. Keep in mind, this is for a very short period. These are per S-share numbers, showing how the value of each share changed over time. For RISA, the net asset value per S-share ended up at $36.53 compared to a beginning of period of $34.39, which is that 12.50% return we saw earlier. The ratio of expenses to average net assets is 1.03%. For FIXBAP, the net asset value per S-share ended at $19.61, down slightly from the beginning of period $20, reflecting that underperformance we discussed. The expense ratio here is 0.69%. And finally, the footnotes. These are super important. This explains how the funds were set up. They are part of Tidal Trust I managed by Tidal Investments LLC, with FolioBeyond's LLC as the sub. Advisor RISA started in September 2021 and FIXP in January 2025. This section details how they value their investments for things like those complex mortgage obligations. They rely on pricing agents and follow strict rules for determining fair value. It also talks about level 1, level 2, and level 3 inputs, which is how they categorize the reliability of the prices they use. Most of RISA S investments are level 2, meaning their prices are based on observable data. FIXP's investments in other ETFs are mostly level 1, meaning they are based on quoted prices in active markets. This part is crucial for understanding what could go wrong. For our ISR, the big risks are related to mortgage-backed securities, especially the interest-only ones and interest rate risk. These can be volatile and sensitive to how quickly people pay off their mortgages. For FIX, key, the risks include investing in other ETFs, which means it's exposed to the risks of those underlying funds, and also risks related to options trading. This highlights that the investment advisor is paid a unitary fee, and that the sub-advisor gets paid from that fee. There is also a mention of a fee waiver on FIXP if it invests in RISR, which is a good sign, showing they are trying to keep costs down for investors. Looking at the tax distributions, both funds paid out ordinary income. RISR paid out a significant amount of ordinary income, while FIXP had a much smaller ordinary income distribution and a small return of capital. And finally, the Auditor S report Cohen and Company Limited says that in their opinion, the financial statements present fairly the financial position of these funds. They've been auditing for Tidal investments since 2020, which is a good sign of continuity. Now, my take on all this. RISA has had a phenomenal year, significantly outperforming its benchmarks by skillfully navigating a rising interest rate environment with its specialized mortgage-backed securities. The Fund S strategy of focusing on interest-only mortgage securities really paid off this past year, showing that sometimes niche strategies can deliver outstanding results when the market conditions are right. The diversification within its holdings of CMOs and agency MBS seems adequate, and the fact that they are mostly level 2 investments gives us some confidence in their valuation. The main risk, as always, is interest rate sensitivity and the complexity of these mortgage-backed products. But based on this report, they managed it brilliantly. FIXBARP, on the other hand, is a very young fund, and it is still finding its footing. It underperformed its benchmark slightly, which is not ideal, but understandable given its short history and strategy of not perfectly matching duration. Its heavy reliance on other ETFs, including the RISA ETF itself, means its performance is heavily tied to those underlying investments. The high turnover rate of 103% suggests active management, which can be good, but also leads to higher trading costs, though the expense ratio is still fairly reasonable. The key risk here is its strategy around options and its exposure to the performance of other ETFs, especially affiliated ones, which could create conflicts of interest. Overall, Rhode Island SR looks like a star performer for this period, demonstrating strong returns and effective risk management in a challenging interest rate climate. FIXB is one to watch, but it needs to prove its strategy can consistently deliver, or at least match its benchmarks over a longer period. Alright, that is our deep dive into these FolioBeyond ETF reports. What is your take on this analysis? Do you invest in these kinds of funds? Let me know in the comments below. If you found this breakdown valuable, smash that like button, it really helps us out, and make sure you are subscribed for more corporate insights. And don't forget to join our Discord community for more discussions and exclusive content. Thanks for watching, and I'll see you in the next video.